And the second thing that the pros do is they control price movement and they control order flow because of the large amounts of money that they have.
Welcome back to Investing with Confidence. I am your host, Joshua David. Always having a great time in studio with my good friend and my great pal, not the special guest, but he is very special.
Oh, I'm no longer special. Oh, I am special.
Yes,
you
are, Mr. Al Connickson.
I'm going to write that down.
There you go. Also, don't forget to subscribe to the podcast. Wherever you listen to podcasts, also check it out on YouTube. If you're just tuning in, Al was shedding some light on how these financial markets actually work and how the public is actually investing after moves in price. So it's important to understand where to identify where that smart money is moving these markets. As we get into this next topic, I wanted to get into how the smart money is creating income. But before we do that, I want to wrap our way into that and talk about why there is such a difference in the results of investors and advisors and brokers and the smart money. There's a big difference there. Why is that?
Yeah. Well, when you look back at a volatile year like 2020, we find even though everybody had access to the same markets, some did very well. They had blowout years. Some lost a bunch. They had blow-up years. And then everybody else was somewhere in between. But why is there such a difference between the pros, who almost always outperform the public, even with these significant up and down moves? So we need to start with why the pros are successful. When I'm talking about pros, that's that smart money, the big institutions, the professional hedge fund managers, and so forth. The first thing that they do is they set rules, and they set rules to something that the public doesn't even know there are rules for. Basically, what they're doing is they're putting the odds in their favor because they're setting the like a casino. They set the rules, and they know that over time they're always going to win because they have the odds in their favor. And the second thing that the pros do is they control price movement and they control order flow because of the large amounts of money that they have. Their big buys, their big sells, that's what really moves price. That's what either turns price a different direction or moves it continuously in the same direction. They also have a plan, and it's a strategy or process that they follow religiously, and they know how to protect. They know how to protect their principal. They know how to protect their profits. Now, let's look at the public. Why is there a difference? Well, this is the bottom line is most of the public think and execute like the rest of the public. In other words, like amateurs. And the key is to learn how to execute your trades, learn how to think and act and execute like the pros do. And that comes from the proper education. Most of the public don't have rules that they follow. And basically, they're investing with their number one enemy. And that's themselves. Human beings just love to make things complicated. I don't know why that is. It's just something we're born with. But you need to stay out of your own way. To properly invest, you have to emotionally detach yourself from your investing and your trading, almost making this kind of boring. That's the only way that you're really going to be able to buy low and sell high, which everybody knows they should do, but actually they do the opposite. And then most people are investing or trading without a plan. They don't have a plan. And I think the number one thing you want to put into a plan is the end point. Where do you want to be? What's your goal down the road? You have to do that to be able to identify how to get to that point. And then your strategy, your plan should be objective. It should have a set of rules that you follow and a strategy or strategies and assets that you identify that help you to maneuver the different and challenging market conditions. There's a lack of knowledge on how the markets work. Most people, really, the way they think the market works is totally different from the way it really does. So you need to understand how the market works, why it functions the way it does, and you've really been taught and kind of conditioned to do things or to accept the fact that number one, the buy and hold strategy is the only way that you're going to be successful. In other words, you put a portfolio together, hold on to it for decades. You've been conditioned to believe that you can't beat the market, that the only important thing is time in the market, not timing the market, and that you need help. You're not smart enough to do this on your own. Those are all fallacies that we address in these classes. And then also, I think people ignore the impact of corrections, Josh. If you are in a portfolio, you have a portfolio and you're in a market correction and the market's down 40%, your portfolio has to come up 67% before you have the opportunity to have any kind of a profit. If you're down 50%, it has to be up 100%. If you're down 60%, and during the market crash in the year 2000, a lot of people that were in technology stocks were down 60, 70%. If you're down 60%, your portfolio has to be up 150% just to get back to the point where you can start making a profit. And that's one of the things that really is a detriment if you're using that buy and hold strategy, because one of the rules to that is that you can't get out. You can't sell. You have to hold on to that portfolio.
Yeah, I'm glad you brought some of those things up, buy and hold, buy low, sell high. I mean, if you think of it this way, everybody knows, as Al is talking about, you're supposed to buy low and sell high. Everybody says that. Hey, you trade markets? Yeah, I buy low, sell high. Everybody says that. But what is the real concept? Most people look at the market and they look for a stock. They look for a stock doing very well. Mm-hmm. They look for a stock that's trending higher. They look for a stock that has a good management team. They look for great things, great earnings in the markets, right? What has happened after all that has happened? The price is already high. So we're conditioned to do it the opposite. People are buying high with the hope to sell higher. And that's why you need to understand core strategy, to understand turns in price, where to buy and also where to sell. And I like how you brought up, the brokers and the advisors. Nothing against the people. It's just the industry. They say you can't do this. You need a professional. You need somebody else to do this for you. I always like to think of the good old Bob the Builder. Can we fix it? Yes, we can. Can we build it? Yes, we can. And think about that. You should have a positive mindset if you want to start to do something. Now we have a little background on why there's such a big gap between the novice, the public, and the pros, the institutions, the banks. There's a couple other reasons as well. The public is only trading stock. That's pretty common, right? Mm-hmm. We see the stock market on TV. That's all they talk about. The institutions are not just trading stocks. They're selling mutual funds, but they're also trading and investing with these other assets, phenomenal assets that the public should understand. Futures, Forex, and options. What are they, and what are some of the perks, and why might the public want to understand more about how those actually function to utilize in their strategies?
Yeah, and that one of the reasons that the public does not do as well as the pros is that they don't understand leverage assets. The worst thing is that they don't understand leverage assets and they try to use them, or they don't understand leverage assets and don't use them, because there's some great benefits. And the reason that the smart money uses these assets is because it really maximizes the value of their investment dollars. And that's really what everybody wants to do. I mean, if you can take $1 and have that dollar be worth 10 or 20 or 50 or $100 of value in your investments, wouldn't that be a great thing to add to your investing and trading life?
And think about this, too. The value of the dollar has been going down since the 1900s, really.
Well, absolutely,
and especially since the Fed was created. I don't remember what year it was, but since then, they've been created, it's been devaluing.
Sure.
So that's why it's important to utilize leverage in your accounts.
Yeah, and if, think of what's happening now with the trillions of dollars that are being pumped into the economy. That's going to have an impact on the value of the dollar down the road too. But leveraged assets are something that certainly should be part of your investment strategy. And you can choose. There are 3 asset strategies that we teach. One is futures, one is the foreign exchange market or Forex, and one is options. And those all 3 have great leverage. They give you the opportunity to have a smaller size account, and that will allow you to participate in a bigger investment. It's sort of like a down payment on a house, a mortgage on a house. You do basically the same thing in the markets. But one of the things that goes along with using these leverage assets, which gives you that great benefit of leverage, is protection. And a lot of people are probably, when they hear us talking about leverage, they cringe and they go, well, whoa, isn't there some risk there? Well, there's risk in everything you do, but the key is to manage that risk. And when you're doing any kind of an investment, understand what the risk is, because that's something that can be managed. And not only the profit potential can be there, but you can do that. You can have that profit potential while still managing risk, and you choose the amount of risk you're willing to take on any individual trade.
And to give an example on how the smart money manages risk, I mean, think of it this way. Most people, hopefully most people, manage their risk when they jump in their car. They put their seatbelt on.
Sure.
If you don't put your seatbelt on, you are at the highest risk if something bad were to happen. But that's the same thing in the financial markets. Mitigate or manage that risk properly.
Absolutely. Yeah, there are seat belts available for your financial investments. And one of the things that our students, that the OTA students use, is a platform, a trading analysis and education platform called Click. And one of the things built into that, in fact, the first thing that somebody does when they set up a Click account, and it's basically, it's customized to each individual, but the first thing it asks is, what is the maximum amount of money you're willing to risk in any trade? And just like everything else in life, the minute you get out of bed, you're facing risk. As Josh mentioned, when you get in your car, you put your seatbelts on.
Especially the older we get, those first couple steps when you wake up in the morning, those are very risky.
Well, just getting out of bed is tough. But yeah, you can trip on the end of the bed and fall on your face. When you cross the street,
Well, if you like in my case, I have a 3-year-old, almost a 4-year-old. I'm stepping on things every single morning. Just keep going.
There are risks in life. Being alive is not necessarily a safe walk down the road. There are risks, but we learn how to control those risks. We know how to identify what can hurt us, and the same thing is true in the financial markets. And by the way, people I think have the misunderstanding that they have to be right all the time when you're investing, and that's the furthest thing from the truth. The pros out there, the smart money, they're happy if they're right 40 to 50% of the time. Well, how can that be? Well, it's because they understand that the most important ratio is your reward risk ratio. It's not necessarily the number of trades that you make are successful, but it's the profit compared to the non-profit. And that's something that we show our students how to identify a risk-reward ratio that will allow you actually to be wrong 75% of the time and break even.
Well, it's a strategy that's designed to teach you to do that. So that's why when you understand how to do that, and by having that plan, actually, then you stick to that plan. And that's what all comes down to, is understanding those techniques and strategies on how to mitigate any risk that you have in the financial markets. We still have a lot to discuss here on Investing with Confidence, and I want to get into retirement techniques and strategies with all assets. We talked about the futures, the Forex, and the options here in this segment. I want you to explain right away, coming out of the gate, what those actually are so our listeners understand that.
Sure.
But also you can use those in retirement accounts. Josh and Al, Investing with Confidence. We'll be right back.